Our first problem is problem 3A. Sales and purchase transactions, of course, using perpetual inventory. The following were selected among the transactions completed by Babcock. November 3rd, purchase merchandise on account, $85,000. Trade discount, first of all, for 25%, FOB, and then 210 net 30. So the first thing is there's a trade discount, so right away we take 25% off. So now we're down to $63,750. Take 2% off of the $63,750 for the 2% discount, and we're going to record it at $62,475. Debit to inventory and credit to AP. Sold the merchandise for $37,680, and the cost of goods sold was $22,600. Of course, it's our two transactions for the sale of inventory. Pretty straightforward. The fifth, purchase merchandise on account from Papoose, $47,500, 210 net 30. Freight was $810. This was FOB shipping point. So the first thing we do is we take our 2% off, 47,500 times 2%, or 47,500 times 98% plus the 810 would get you to 47,360. So we are capitalizing the cost of freight with FOB shipping point. On the 6th, we returned some merchandise. The invoice was $13,500, $18,000 list price with a trade discount of 25%. Purchased on November 3. So of course we took that 25% off, which is the $13,500, but we also have to factor in we took that 2%. So when we return it, it's $13,500 less that 2%, or we're going to have too much coming out of that AP. We can't take out $13,500. We can only take out or return $13,230. That's what we had put it in at, and that's what we showed that we owed. On the 8th, we sold some merchandise, $15,600, and a cost of $9,400. Again, this is the typical two transaction for selling of inventory. On the 13th, paid Moonlight on account for a purchase on November 3rd, less that return. So we had $62,475 less this return of $13,230, which means we're going to debit AP for the net of $49,245. On the 14th, we sold merchandise on Visa, $236, and then there's some cost of goods sold. Again, anything with a credit card is considered cash, so debit cash, credit sales, debit cost of goods sold, inventory for the sales, and the cost. On the 15th, paid Papoose, what we bought on the 5th. We bought $47,360 back here on the 5th, so now we debit AP and credit cash. On the 23rd, received cash on account. So cash on account on November 8th. So right here, this was debited for $15,000. So now we're going to debit our cash account and take it out of AR. On the 24th, we sold some merchandise again. The cost of goods sold was $34,000. So in this case, we are going to take that 1% discount because we sold merchandise on account. Terms 110, net 30. We'll show it as of the net that they took the discount. So $56,331 less. So you could take 56,900 times 99%, and you would get that number. And then, of course, we have to record the cost of the goods sold of $34,000. Paid Visa for this $35.40, the expense, credit card expense, and a credit to cash. Paid Quinn a cash refund of $6,000 for returned merchandise. So it would have been put into customer refunds payable $6 and credit cash for $6. And then the cost of this inventory, so we're putting it back into inventory of $3,300, and we take it out of that estimated returns inventory. So that takes care of problem 3A. Problem 4A. basically more of the same. Summit Company sold merchandise on account, $48,000. FOB destination, $210. $215. The cost of goods was $28,800. So, again, $48,000. We're going to take our 2% discount as if right away they take it. $47,040 and our cost of goods sold transaction. Summit Company paid freight, $11.50 for the delivery of merchandise sold to Beartooth. We paid it, delivery expense, and a credit to cash. On the 5th, Summit sold merchandise on account, $66,000. Cost of goods sold was $44,000. Again, just our normal 2 transaction. Whenever you sell inventory, 2 transactions, the sales and the cost. On the 15th, Summit Company sold merchandise on account, $58,700. FOB shipping point, net $45,000. Summit paid freight of $16.75, which was added to the invoice. All right, so it was added to the invoice, and the cost of goods sold was $35,000. So $58,700 was the sales. There was no discount. So here's our sales transaction, AR and sales, and then we also had the cost of that inventory right here. So we got transaction 1 and transaction 2, but we also paid that freight, which was added to the invoice. So they're going to have to pay us that as well. So we credit cash because we paid it, but they will reimburse us the freight of $16.75. On the 16th, Beartooth paid Summit for the purchase of August 1st. August 1st, $47,040 up here, AR. Now it's getting paid. Debit cash, credit AR. On the 20th, it reads, Summit Company paid Beartooth a cash refund of $1,000 for defective merchandise. So this is where we put that new account, customer refunds payable for $1,000, and we paid it credit cash. Okay. On the 31st, Beartooth paid Summit Company on account for the purchase of August 5. Here we go, $66,000. Here we go, they paid it, $66,000. Debit cash, credit AR. 31 again. Summit Company issued Beartooth a credit memo for the merchandise with an invoice amount of $4,000 that was returned from the August 15th sale. The cost is $2,500. So we then reduce their AR because they haven't paid us yet, but we put the $4,000 into a customer refunds payable. We credit this estimated returns inventory and we put it into inventory for $2,500. It's coming back into inventory. Then it also asks for this problem, do it for Beartooth. So the opposite side. Okay, so we did all the transactions here for Summit. This was Summit's transactions. Now, what does it look like for part 2, Beartooth? All right, so number 1 again, August 1st, Summit Company sold. Beartooth bought it. Well, we bought it at that 2% discount, so we don't care about all of, we don't care about all of this stuff. We do know that that's what we bought it for, $47,040. Debit inventory, credit AP. On the 5th, again, Summit sold to Beartooth. Summit Company paid freight of $11.50 for delivery of merchandise sold to Beartooth. Well, we don't need to do anything for that because that was something only Summit did. On the 5th, Summit Company sold again to Beartooth, $56,000. $66,000. So we just again debit inventory, credit AP. On the 9th, Beartooth paid the freight. So in this case, we're going to put it all to AP. But what did we purchase? We purchased up here $58,700 of this sale, right? That was our sale. That's what Summit had for a sale, so that's what Beartooth bought, as well as this freight that was due. So all of it's going to get capitalized to inventory, and we owe all $60,000. So $60,000 inventory, and it's AP. On the 16th, Beartooth paid again to Summit the purchase of August 1st. Here we go, $47,040. So reduce the AP, credit cash. On the 20th, Summit Company paid Beartooth a cash refund. So Beartooth received that $1,000, but we returned that inventory. And then the 31st, Beartooth paid Summit again from the August 5th. So if you look up here, there was AP. So we're going to debit that AP and credit cash. And then lastly, Summit Company issued Beartooth a credit memo, $4,000. We don't need to know about the cost. Summit does. So AP, we don't owe as much, and we return that inventory. So before I'd move on, I would once again review all of these exercises, make sure we understand what are we debiting and crediting. Are we the seller or are we the buyer? But all of the exercises and problems from Chapter 5 would be worth your time to review. That takes care of our assignment from Chapter 5.